Share screen. All right. Just want to make sure everyone can see my screen before I go ahead and get started. Is that a yes or no? Can you guys see
Yeah, I
my?
can see it.
Yeah, I can see it.
All right,
Yeah, we can chat.
awesome. All right, so high strike diamond lesson 8. I believe I'm on the right lesson. Ben Chafee isn't in yet, so he's not there to tell me if that's right or wrong, but the last one was 7, so I'm going to go with this is 8. Oh, I think no, this was, did I click on the wrong one? Yeah, I clicked on the wrong keynote. Hold on. There we go. This is lesson 9. I believe we were on lesson 8 and this is lesson 9. So let me just go ahead and make sure I have my TOS right next to this. All right, so today we're going to be going over intrinsic value of options, extrinsic value of options. We're going to go over the Greeks. We're going to recap delta and theta, and then we're going to go and go into gamma. And then we're going to go into vega as well as implied volatility. After that, you guys will kind of have everything under your belts as far as options, and you'll see really why they're so complex and why it's really easy to lose money with options if you don't know how they work and what you're doing. So we'll go ahead and jump right into it. So intrinsic value, we'll start here. So intrinsic value is the value any given option would have if it were exercised today, right? So this is like, you have in the money options, you have out of the money options. Out of the money options, if execute or exercised, just like the gas contract, a gas, or like I was using the other day, a gas contract, wouldn't have any value if the price of gas was $3 and I have a right to buy it at $4, right? Because, who wants to buy gas at $4 when you can just buy it at $3, right? So if I have one at $2, then $2 actually has value. So that's like the intrinsic value, right? Intrinsic value is the value any given option would have if it were exercised today. Basically, the intrinsic value is the amount by which the strike price of an option is profitable or in the money as compared to the stock's price in the market. If the stock price of an option is not profitable as compared to the price of the stock, the option is said to be out of the money. If the strike price is equal to the stock's price in the market, the option is said to be at the money. Intrinsic value, an in the money option has an intrinsic value by the amount it's in the money. A call option with a $20 strike price on a stock currently at $25 is in the money by $5, right? So if I have an option, I have a $20, let's just say I'm trading something cheap. Let's just say SoFi. I know it's a little cheaper than this right now. Let's say with SoFi, I have a $20 call and the current price of the stock is at $25. This option, this call option is in the money by $5, right? Out of the money would be, well, actually, we'll go into that next so it doesn't get confusing. If you held this call option, you could exercise the option and buy the shares for $20 and immediately sell the shares for $25, pocketing the $50 or the $5 per share intrinsic value. Options that are out of the money, out of or at the money have no intrinsic value, right? So, coming back to, the right to buy gas, right? If I had a right to buy gas at $2 and the price of gas was $3, I could, go ahead and buy 100 gallons of gas at $2, and then I could go sell that gas to someone else for $3 a gallon and profit $100 off of that, right? So that, right to buy gas has intrinsic value. The intrinsic value is the value that if the option were executed right now, or if, the right to buy was executed right now, it has value because of that. So if we go ahead and we actually, I would say we're going to come over and look at TOS, but I'm going to go over intrinsic value first, and then we'll go ahead and look at that. So that's intrinsic value. And if that doesn't make sense, we'll go over it a little deeper here once we go into TD Ameritrade in just a minute. And then I'm going to cover intrinsic value. Intrinsic value measures the difference between the market price of an option called a premium and its intrinsic value. Extrinsic value is also the portion of the worth that has been assigned to an option by factors other than the underlying asset's price, right? So this is, the option has price because of the fact that there is time until expiration, or because of volatility, which we'll also cover volatility more towards the end. The opposite of intrinsic value is intrinsic value, which is the inherent worth of an option, right? So an option that's in the money has extrinsic value and intrinsic value, where an option out of the money actually only has extrinsic value, right? Because if you were to execute that contract right then and there, it's worth nothing. So the only value that that contract actually has is the potential, which is measured through time and volatility until its expiration, right? So the extrinsic value of an option is the portion of an option price that is not intrinsic value. If the price of a $20 strike call option on a $25 stock is $7, the $2 above the $5 intrinsic value, the extrinsic value out of the money and at the money option prices consist of only extrinsic value. The value is often referred to as time premium. The time premium is the value in an options price that covers the right given by the option contract in relation to the time until the option expires. Extrinsic value raises with increase in volatility in the market. That's something that we'll cover as well. So that might be a little bit confusing. So let's come over into TD Ameritrade and actually break it down a little bit more, right? So I came over, here's my charts tab. I have Amazon stock loaded up. I'll load up S&P 500, just to make things possibly a little bit easier. So this is my charts tab. I come over to the trade tab. This is where you find options. You can change the layout to last, net change, Theo. I honestly don't know what that is. I've never used that, probably never will. Volume and open interest. I've used this. Implied volatility, probably yada, yada, yada. We are using position, intrinsic value, and extrinsic value, right? So we'll go through these two dates right here. So we have April 1st. So these are options, really that expire in 5 minutes, because SPY contracts are all indexes. The option contracts will move 15 minutes past the close. Any stocks, the options on normal stocks, Amazon, Apple, Microsoft, stuff like that, they stop moving right at 4 o'clock Eastern time. So you can see that we'll actually use April 4th. So these options expire on Monday. You can see that all of the out of the money options, this is the intrinsic value column, this is the extrinsic value column. All of the out of the money options don't have any intrinsic value, right? Because if these were executed right now, it wouldn't be worth anything. And, same goes for the put side, right? You have the intrinsic and extrinsic. Any of the out of the money, which is obviously represented by the red, or sorry, I don't even know where I pulled red out of, but represented by the black. Black is out of the money, blue is in the money. This is the strike right here, the current strike. If we actually look at SPY right here, SPY is at 452, right? So 452 call is going to be in the money, where 453 call is going to be out of the money, right? Because 453 is above the current strike price. And 452 is below the current strike price, right? Because it's at 42.50. So anything below 452 is in the money, because it's, it's below the current strike price as far as calls go. And then anything above the strike price where the stock is at is out of the money. And obviously it's inverse for puts. I'm gonna take a drink of water real quick. So all options that are out of the money on the put side or the call side don't have any intrinsic value and only have extrinsic value. Now, extrinsic value is time and volatility, right? So the only thing giving this contract any value right now is theta and vega. And we'll go over both of those, like I said, in a minute or in a little bit. Now, the in the money options actually have intrinsic value, right? Because if they were executed right now, that's how much they would be worth. This is why on Fridays, right? Because Fridays, most contracts expire on Friday, say April 1st, right? Today's a Friday. This is why options, trading 0 DTE is so risky, because you're trading, this time value and this, volatility value gets a lot smaller and ultimately will end up at zero, like these, right? It says 1 cent, 0 cents. These all ended up at zero because they don't have any intrinsic value, right? So when you're trading when you're trading these contracts, they're out of the money, you're really trading time and volatility, right? And when you're trading in the money, you're actually trading intrinsic value, time, and volatility. So that's why it's safer to trade in the money contracts, but that's also why they don't move as much, because you're trading two different factors here. Whereas with out of the money, you're trading that one factor, which is the extrinsic value. This factor is 0. And that's why it's the best if you can you'll make the most money if you can trade options from out of the money to in the money, right? Because you're taking it from a factor, say right here of, it only has, one value that gives it value, which is extrinsic value. Whereas when you take it in the money, now it has two factors that give it value, right? It has intrinsic and extrinsic value, where, it doesn't have that when it's out of the money. Is everyone tracking with that? Does that make sense? I know that's, kind of advanced, but I did the best I could to break it down. But if someone has questions, please ask them now, because we are going to move on and I want to make sure you guys have an understanding of this. So I'm going to give you the next 1 minute. If you do have questions, please do ask them, because I want to make sure you guys understand this so that you understand the next stuff. Everyone's understanding this. No one's lost. I'm gonna assume that if you're not saying anything in chat or over the mic, that you're understanding it. So, all right. No one? All right, we're gonna move on. So that's intrinsic value, that's extrinsic value. When we're trading out of the money, we're trading extrinsic value. When we're trading in the money, we're trading intrinsic and extrinsic value. Usually extrinsic value is where you see the most price fluctuation when it comes to, those big returns that you see on options contracts. But when it comes to trading contracts that are expiring soon, the more in the money you go, the safer they are, because they actually expire with value. Whereas, obviously out of the money, they don't expire with value, and they just don't move as much because they already have value. Whereas if you go from no value to value, you're going to have the best return. So now let's jump into the Greeks. This is the same one that we had the other lesson. So I'm just going to go ahead and read this again. The option market uses the term Greeks to describe the different dimensions of risk involved in taking an options position. These variables are called Greeks because they are typically associated with Greek symbols. Each risk variable is a result of an imperfect assumption or relationship of the option with another underlying variable. Traders use different Greek values to assess option risk and manage option portfolios. All right, so we're going to go ahead and just do a recap on Delta. All right, let's see, we got a question. So they have a topic with these PowerPoints. Yeah, I can make these available in Kartra if you guys want to download these and go over after. Obviously, the video will be available as well. You got it. So Delta is a measure of the change in an option's price. That is the premium of an option, which is the cost. When I come over to TD Ameritrade and I look at the bid and the ask, this is the price of the option. This is the option premium, right? So Delta is the measure of the change in an option's price, the premium, resulting from a change in the underlying security. The value of Delta ranges from -100 to 0 for puts and 0 to 100 for calls. And this is measured in decimal points. If I actually move this over to the Greeks, delta, gamma, theta, vega, the delta is measured in decimal points. So 1.00 is equivalent to 100. 0.04 is equivalent to 4. 0.28 is equivalent to 28. So that's just what I'm getting at here. Puts are -1 to puts range from -1 to 0, and then calls from 0 to 1 without the decimal shift respectively. Puts generate negative delta because they have a negative relationship with the underlying security. That is, put premiums fall when the underlying security rises, and vice versa. I forgot to close my door. So that's delta, right? Delta, this delta number measures how much the the option premium moves per $1 in the stock price, right? So, this is probably a bad example because these options, just stop trading and are basically done for. So the ones expiring on Monday, right? This 452 call has a delta of 54. So if SPY moves up $1, this contract is going to go up $54 in value based on this delta. And, it's obviously same for all of these as well. So that's delta. Now let's recap theta. Theta measures the rate of time decay in the value of an option or its premium. Time decay represents the erosion of an option's value or price due to passage of time. As time passes, the chance of an option being profitable or in the money lessens. Time decay tends to accelerate as the expiration date of an option draws closer because there's less time left to earn a profit from the trade. So obviously, these theta numbers right here are all 0 because time has run out. These options are now either expired out of the money or expired in the money. These were options from today. They expired 4 minutes ago. These options expire on Monday. So you can see the theta here. We have for this 453 call, we have a theta of 28 or 0.28. So 0.28 is going to be removed from this option in value by tomorrow at 420 or 415. This is still fluctuating a little bit. This is going to fluctuate more. But yeah, that's theta. Okay, so we're about to go deep dive into gamma, IV, and Vega. Does everyone's tracking with everything I've just said? If you're not, please send a message. Otherwise, I'm going to move forward. I'll take a drink and give you guys a second if you don't. Cool. Get ready. All right, pay attention here because we're going to go into gamma. And I'll read this and then I'll explain a little bit. Gamma represents the rate of change between an option's delta and the underlying asset's price. This is called second order or second derivative price sensitivity. Gamma indicates the amount that the delta would change given a $1 move in the underlying security. Let's assume an investor is long one call option on hypothetical stock XYZ. We'll call this SPY, whatever we want to call it. The call option has a delta of 0.50 and a gamma of 0.10. Therefore, if stock, XYZ increases or decreases by $1, the call option's delta would increase or decrease by 0.10, right? And I'll again explain this more after I finish reading this. Gamma is used to determine the stability of an option's delta. Higher gamma values indicates that the delta could change dramatically in response to even small movements in the underlying price. Gamma is higher for options that are at the money and lower for options that are out of the money and in the money, and accelerates in magnitude as expiration approaches. Gamma values are generally smaller the further away from the date of expiration. This means that options with longer expirations are less sensitive to delta changes. As expirations approach, gamma values are typically larger as price changes have more impact on gamma. All right, so a little bit of an example. Gamma is basically the delta of the delta, right? So the delta of an option is how much the option will move based on the underlying stock price, where delta or gamma is how much delta will move based on delta and the stock price. So look at it like this. Is a great example that I found. If you're driving a car at 30 miles per hour, if you increase your speed to 40 miles per hour, you have accelerated by 10 miles per hour, right? If you think of speed as your delta, then the change in your speed is the gamma. In other words, gamma is your acceleration, right? So gamma is how fast you went from 30 to 40 miles per hour, right? So the increase from 30 to 40 is your delta. I'm going 30 miles an hour. Now I'm going 40. That's my delta. Then my gamma is, did I get from 30 to 40 in 1 second? Did I get to 30 to 40 in 5 seconds? Gamma is how fast you got there, right? So in order to calculate gamma, we have the original delta and the original stock price. And then we have the original, or I guess I kind of got ahead of myself. So delta, the original delta minus the new delta divided by the stocks price minus the new stocks price, and that equals gamma, right? So gamma is going to be the highest at the money, and it's going to be the lowest out of the money and in the money. And we'll actually take a look at that right now. So if we look at gamma, we have delta, gamma, theta, vega. Gamma right here, you can see is the highest, 10, 11, 10, 10, right at the money. At the money just means, pretty much these two right here. And then in the money, gamma essentially goes to 0, 0.2, 0.5, down here, 0.2, 0.4, right? So gamma is the highest right here. So gamma doesn't have a direct impact on the price of the contract, but it has a direct impact on delta, which delta has a direct impact on the price of the contract, right? So gamma is telling me how sensitive or how much delta will move when the stock or the underlying security does move. So you can see the gamma is higher closer to expiration. Obviously these just expired, so the gamma is really high here. The gamma here is a little lower, here it's even lower, here it's even lower, right? So this means that the further out of the money the contract is, or sorry, the further away from expiration it is, that means the less the contract's price will change when the underlying option changes, right? So let's do a little bit of math here. I know this is a little bit of a complex topic. So basically what this means, right? We have the 453 call. When the 453 call, SPY's price is at, let's call it 452.50. It's at 452.57. Let's call it 452.50, right? The delta right now is 56, right? So this means that if SPY moves from 452 to 450, or right now if it moves from 452.50 to 453.50, then this contract 175 is going to go up $56 in value, right? But because we have gamma, now that adds another part of the equation in there, right? So after this moves $1 in that direction, gamma has a direct impact on how delta moves. So when delta moves to that price, $10 or 0.10 is going to be added to the delta. And you can actually see this, right? So when say we moved $1, right? What's 56 plus 11? We get 67. What's 67 plus 10? 67 plus 8? Boom, it's 75. What's 75 plus 7? It's right around 83. So this just gamma is telling you how much delta is going to speed up or slow down, right? So if we go from we take 45 and we subtract the gamma of what it would be after $1 move down to 30, 10 divided, or 10. Oh my gosh, I'm tripping up here. Sorry, 45 minus 10 would be 35. And obviously there's a couple little point moves in there, like 17 minus 0.7 is right around 11. So gamma is just going to tell you how sensitive the delta is going to be for $1 move. Now, watch how dramatically this changes between Amazon. Amazon obviously is a bigger name, right? We have the stock prices at 32.66. So $1 move doesn't really mean much, right? $1 move from 27.70 to 27.71 is not as big of a deal as a smaller name, right? So if we look at the gamma is actually non-existent, right? So this means that as delta moves, we don't even have to focus on gamma, because gamma is not going to move at all. We had a little bit of gamma here for expiration, because remember, gamma accelerates the closer it is the contracts are to expiration. But contracts expiring next week, we don't even have any gamma for those contracts. But if we actually come look at NEO, actually let's look at SoFi, because it's going to be more dramatic, right? SoFi, $1 move in SoFi means a lot, because it's a $9 stock, right? So if we look at the gamma in SoFi, we actually had a 0.129 gamma at this point, right? So that means if, and remember this accelerates the closer we're to expiration. So This is the last day till expiration. So if SoFi went from 9.5 to or 9.3 to 10.3, which is a huge move, right? That's a 10% move in the company. So that's a lot, right? Then this option is going to move. Obviously, it's worthless right now, so we use the one that's not worthless. This has a delta of 87 and a gamma of 70, right? So this is going to move from 31 to, or let's call it 35 because of the spread, 35 plus 80. Did I say 80 or 80? I know I said 80, but I think it was 85. So 115, 87. Let's call it 120, right? So if this goes from 932 to 1032, then this contract rate here is going to go from 35 to or 0.13 or 0.35 to 1.20 to 120, right? Because of this delta. Now, this gamma after that $1 move is going to be added to this delta. So this will be sitting at 157 delta right after that move, which isn't perfectly represented here because these options expired. It would be a little bit better represented here, where we have a delta of 67 plus a delta, or sorry, plus a gamma of 26, and we're right around that 84 range, just like 84 delta plus a gamma of 12, we're right around that 95 range, 96, and so on, 95. And this is basically just telling you that, the further in the money you go, the less the stock is going to move, or the less the option is going to move. And the further out of the money you go, the less the option is going to move. This is basically just telling you that the most movement is going to be at the money, and the closest to expiration, right? So that's basically what gamma is. I know that's very confusing, and there's a lot to that. Is everyone tracking with that? Because this was a tough one for me to understand, and I learned it as well. Drop a message in chat if it does not, and we'll cover why it doesn't. All right, so everyone's tracking. Cool. So that's gamma. Now, instead of moving right to Vega, I'm actually going to move to implied volatility first. So implied volatility is the market's forecast of a likely movement in a security's price. IV is often used to price options contracts where high implied volatility results in options with higher premiums and vice versa. Supply and demand and time value are major determining factors for calculating implied volatility. Implied volatility usually increases in bearish markets and decreases when the market is bullish. Although IV helps quantify market sentiment and uncertainty, it is based solely on price rather than fundamentals, right? So implied volatility right here says is usually increased in bearish markets, which is definitely the case right now. Basically, implied volatility is when IV is high, that means there's an expected move that's going to be big. When IV is low, the expected move is going to be small, right? So you can see IV right here. So the IV for SoFi right now is 224%. So it's expecting plus or minus 12 cents in stock price. Now, if we come over to SPY, obviously this one just expired. So by Monday, we have 11.16% IV. We're expecting a plus or minus of $3.65 by Monday, right? So this is not saying, oh, by Monday, we're either going to move $3.6 up or $3.6 down. That's just an estimate, right? So if we're expected to move more based on the past, then this number is going to be higher. The implied volatility is going to be higher. And if implied volatility is higher, the contract price is going to be higher as well. I wonder if we have, yeah, we do have implied volatility on contracts. Oh, there was one other thing that I wanted to drop with you guys as well before I move on, and that's delta. So another thing about delta is delta is kind of going to tell you how likely it is, and this obviously goes into calculating the contract price, how likely it is that option will expire either in or out of the money, right? So there's a 55% chance that this option expires in the money, 46% for this one, 37% for this one, 29%, 23%, and it obviously moves up. This one's 90% chance, 79%, so on and so forth. Sounds good, Todd. All right, let's switch back over to IV. I honestly don't look at the IV for contracts themselves, but it is a relevant thing. I just look at the IV for the underlying security. So in this case, if I'm trading SPY, then I'm looking at the volatility for SPY. Take a drink real quick. Now let's come over and look at, I believe AMD has earnings. Yeah, let me actually look. I'm going to look it up on Instagram. Give me 1 second. So the way that I look to see if something has earnings is I go to Earnings Whispers on Instagram, and then I go to their website, earningswhispers.com, and then I'll just go look up a name. I believe I heard Sage talking about AMD having earnings soon. No, they have earnings on May 3rd, so like in a month. Let's see what's gonna have earnings this week. Let me see. Okay, so earnings this week. That was, let's just look it up. Okay, thank you, Mike. AMD on 4/26. Okay, so AMD has earnings 4/26. So in like about 3 weeks, I would, want to give an example that is like this next week, because then you would see it. But let me just look it up real quick. This week. Let's see. Okay, April. Okay, yeah, perfect. They have earnings on Monday. Let's see. We'll just find one right here. Mara. I've traded Mara before, so I'm going to go with Mara. All right, so Mara has earnings. What are they even trading at? Okay, yeah. So Mara is expected to have a $3 move, and they're trading at $28. So percentage wise, that's like a 20% move. So you can see IV is a lot higher. Now you're going to learn in just a minute that IV is going to also give contracts an inflated price or not. So we'll actually move into that so that it makes a little bit more sense. So the last slide is understanding Vega. Vega represents the rate of change between an option's value and the underlying asset's implied volatility. This is the option's sensitivity to volatility. Vega indicates the amount an option's price changes given a 1% change in implied volatility. For example, an option with a Vega of 0.10 indicates that the option's value is expected to change by 10 cents if the implied volatility changes by 1%. I think you guys can probably see where this is going. Because increased volatility implies that the underlying instrument is more likely to experience extreme value, a rise in volatility correspondingly increases the value of an option. Conversely, a decrease in volatility negatively affects the value of an option. Vega is at its maximum for at the money options that have longer times until expiration. All right, so let's look at this a little bit. So we can see Vega right here, which is surprising that I guess it's already pretty high. So let's look at this, right? So the IV for contracts this week for Mara was 82%. And the IV for contracts next week is 103%. So that's a 20% difference. So what does that mean? That means that Vega right here, the contract is going to be priced at 2 cents difference, which is basically $2 out of this, $132 contract difference. So if this changes 20%, then that's a $40 difference in this, $135 contract, which percentage wise of that contract is dramatic. So this is why right before you have an earnings move, option prices are going to be a lot more expensive because there's a big move expected to play out, whether it's to the upside or to the downside. And because of that, IV, implied volatility, which is the market forecasting a big move, right? Earnings usually means a big move. We've seen Amazon move like $300 after hours, which for the company is a big move. This is, okay, let me take a drink real quick. So let's come back over to SPY. Oh my goodness, sorry guys. Focus, there we go. All right, so let's come back over to SPY. So we have 11%, then we have 14% right here and 15% right here. So that's obviously only 2 day different from April 6th to April 8th. And for every percent that this implied volatility goes up, this Vega number is going to move the contracts that much, right? So if SPY implied volatility rockets up to 15% in a day, which is would affect this number right here, then these contracts are going to go up. What it would be $60 on top of this, so they would go from 125 to then 185 just from Vega, right? If nothing else changed, if Delta, Gamma, and Theta didn't change, Vega alone would cause these contracts to go up. That'd be like 33%, right? So I think you guys can understand now why options are a lot riskier, and how there's a lot more that plays into options, right? You have Delta. Delta is, similar to if you're trading shares, the price of the share indicates the price of the share, right? Delta determines the price of the option, but then Gamma determines the price of where Delta will be. Theta determines the price of the option as well, based on how much time is left on that option. And then Vega determines a piece of the price as well, based on the implied volatility of the underlying security, right? So in this case, we're looking at SPY contracts, the implied volatility of SPY. I'll actually look at the VIX real quick, which is the fear and greed index, right? So look at this on a 1 day chart. So when fear is high, volatility is high. When fear is low, usually volatility is low. When people are fearful, then the market can kind of go crazy. As you can see, why are we looking at SPY? We should be looking at VIX. There we go. Usually when VIX goes up, the market's going down. And when VIX goes down, the market's going up. And if we actually look at it, my chart's a little dirty here, but you can see, when VIX was coming down, the market was in a downtrend. There was a lot of fear. There was, news with Russia and Ukraine. There was I think some COVID stuff too. And then when the market's pushing, usually news is better. There's less fear in the market. VIX goes down. So for me, I started my account, my $100 account in January. So it was really hard for me to trade that account because implied volatility was really high because of all this fear in the market, right? If we look at VIX, right around, I started my account end of January. And if we look at that, end of January, VIX was pretty high, which is the, fear and greed index. So volatility was high, which means contract premiums were higher. And because of that, starting with a $100 account, it was tougher to forward contracts. I'd have to play further out of the money, which means, it was even less chance that they went into the money. So they had, no intrinsic value and even less extrinsic value. So it was really tough to start then. Whereas trading contracts down here in this zone is going to be a little easier because implied volatility is going to be less. It's just when you're looking at the Greeks, Vega is not going to be as big of a factor when volatility is low, but it's going to be a lot bigger when volatility is higher. This is why, and I'll kind of wrap up with this point, and then we can push into Q&A, is when we're trading, I'm going to come into SPY. This is why contracts move when they're out of the money, right? So if we come over to the 5-minute, let's say rate here. So this is what people don't really understand with options. We'll take this play, for example, right here. This is kind of like a inverse H. We came up, we tested this, 4450.87. We came down and then we broke through it, right? So if we buy, and this is why options can really get crushed if they go the wrong way, or they can really blow up in a good way if they go the right way. Say I buy an option, right here, or say right at the top right here, right? So when it starts to go down, the volatility for that contract also, actually, I think I had a slide on this. Slide deck. Supply and demand and time value are major determining factors for calculating implied volatility. So, right, when the stock is pulling back, the demand for calls as the stock is pulling back is going to be a lot less so. So, because the demand is less, the volatility is going to be impacted by that and it's going to drop. So this contract is not only going to be crushed by delta, it's going to be crushed by, gamma is going to impact the delta, which brings the price of the contract down. Obviously, if you're trading out of the money, especially if it's close to expiration, the likelihood of it expiring in the money, if it's out of the money, is going to be lower when it's down here versus when up here. So theta is going to have an effect on that. And then, it's going to have IV crush as well, because there's not as much interest in buying that contract when the price is going down, right? Everyone wants to buy calls here. No one wants to buy calls here. Everyone wants to sell their calls here. So supply is high, demand is low, supply is low, demand is high, right? And that's going to have an impact on Vega, which is going to have an impact on the price. And then obviously delta is going to be affected here. Theta is, it's still eating at the contract, especially right here, because, it expires in what, like 10 minutes. So, but your biggest things there are going to be Vega. And, there's a really good example of this, right? So if we look at CAR and we look at the 1-day chart, there was one day where CAR went from $173 up to $545, which is literally insane. Those contracts, you would have literally become filthy rich if you had even $1,000 in them. But obviously the chance of that happening is literally zero. But my point here is that, let's scale out a little bit. So if you say you bought calls right here, and then, this is ripping up, right? You have multiple things working for you, right? So the volatility is going to start to skyrocket, right? Because a move like this is not normal. You look at, all the daily candles and everything. A move like this for CAR is not normal at all. So volatility is going to spike and spike and spike and spike, and it's going to blast up, right? Percentage wise, it's going to stack, which is going to contribute to the price of the contract going up, which is great if you bought the contract before then, and then you go to sell it. But you're also going to have delta and gamma both working for you as well. Theta is obviously never working for you as a buyer. It's always working against you. But in a move this swift, you're not even really going to notice it. And then, if you buy contracts at the top, you're literally going to get destroyed, because as the move comes back down, the volatility there for that is going to be less and less, right? So the contract is going to come down in value because there's not as much implied volatility. So Vega is going to drop the price of the contract. And then obviously gamma is going to have its effect on Vega, and Vega is going to, gamma is going to have its effect on delta, and delta will drop the price of the contract as well. And then you have time decay working against you as well. So when you're in calls after a big move like this, you're literally going to be having everything working against you. Now, this is why if we come over to here, for me as an options scalper, day trader, I swung options, and that kind of threw me off. So I'm probably not going to really do that much anymore. I don't really like to swing options, but we'll use right here. Let's find like a fake out. So for this example right here, right? Say we want to play a low of day break on SPY right here, right? So if we're, for shares, this isn't something that's like an issue, right? You can go ahead and, if you're like, okay, I want to short SPY, I'm just waiting, for this to like fake out or to break out, so after we have a confirmed breakout here, right? Maybe you buy, short, or you short shares right here. You're like, okay, I think it's going to go down, so I'm going to short it. And then it comes back, you have your stop loss at break even, no worries. It goes down, you buy in at 449.16 and now it's up at, 35. So what you lose, 18 cents per share, not a big deal, right? That's the price. Now, if you buy puts right here, you just had a move happen and then another move happen, right? So the IV is going to spike up a little bit and it's going to inflate that contract price a bit. So just like, I don't know if you guys have ever seen contracts move, but when a move happens, big move, you can just watch those contracts skyrocket, right? Because Delta's working for them, Gamma's working for them, and Vega's working for them. So if you buy right here, supply is low, demand is high, so the price is going to be raised. This is just like anything, right? When supply is low and demand is high, the price goes up. Same with contracts, same for option contracts, right? So, right at the tip right here, this is a fake out because we broke below low of day and, we did not continue. So this was a fake out. So if you bought after this candle closed below here for like, confirmation, then, you got stuck in this pullback, this fake out right here, you would get crushed right here, to an extent, depending on, what contracts you play and everything, right? Because supply is low, demand is high right here. Everyone wants puts because it looks like it's breaking out. Delta is working for the price of the contract. Vega is working for the price of the contract. Gamma is working for the price of the contract. And then you get caught in the pullback. And this is where people get crushed on options, right? Because now, supply is high, demand is low. No one wants to buy puts right now because the price is going up. So the price of the contract is going to plummet. It's going to get crushed, right? Even though you bought in right here, even at this point, the price of the contract is going to be less because the demand here after this candle is high, and the demand here after this body or even here, if you sell here, the demand is going to be much lower here than it would be like right here. Right? Because everyone's trying to get rid of it. So there's a lot of supply and there's low demand. No one wants to buy puts, when the stock's going up, so, right here, you have everything working against you. You don't just have the price of the stock working against you. You have Delta working against you. You have Gamma working against you. You have Theta working against you, time decay. You have Vega working against you. So you literally have all the Greeks working against you whenever the stock is going in the opposite direction of what you're playing. Now, this is something we went over on a webinar with Umar. If you buy like in this chop right here, then, and you're buying puts and, you buy in here, Vega is going to be lower. Supply is higher, demand is lower, right? Because we're not really doing anything, right? Just like, volatility, if the stock is not really moving, volatility is not that high, and then the stock breaks out of this, little bitty range right here, right? Well, now volatility is higher because a move happened that it wasn't the same as before, bigger move than what was happening. So Vega goes up, which brings the price of the contract up. Delta obviously is, obviously it's inverse for puts, but Delta goes up, Gamma goes up, right? So the price, if you buy in here, your price is going to be at peak, in this, heightened volatility and this heightened demand. So if you sell into high demand, that's where you're going to get the best price for your contract. If I buy calls right here, I'm going to get a lot better price for my calls if I sell here than if I sell here. Even though it's at the same level, I'm going to get a much better price here because there's heightened volatility after this move, and the demand's much higher here than the demand will be here, right? Because these 3 candles just happen, big move just happened, everyone wants to buy calls. Whereas right here, it's like, okay, we're kind of just chopping around. No one really wants to buy calls. But if you buy calls here, and then, you capture this move and sell into strength, and that's why we, we say buy the dip and sell the rip, right? So this would be like the dip right here, and for me, if we're coming down here, maybe I see us making a little bit of a bottom. I'm just going to move this. I see us making a little bit of a bottom right here. Maybe I say, I see a little bit of strength right here and, not much of a pullback. And I'm saying, okay, I'm looking for a break above this level. So I'm going to go ahead and enter here for an options play because, it's something that you have to trade options differently than you trade shares. Yeah, you could buy shares right at the break right here and you could sell them right. You could, with shares, I could buy in, on this candle, and it doesn't matter if I sell them here, 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 whatever level it's at, that's the price of the share, right? But it's going to be very different for options, especially when they're close to expiration. Supply and demand. So, you have to trade options differently, right? So for a move like this, I'm saying, okay, maybe my level, this purple line is VWAP. Maybe I'm looking to sell at VWAP, right? So, I see this kind of this little bit of a pullback, here after this nice strong move. And then I see us kind of making a lower low here. I say, okay, and I want to enter right here, because it looks like we could potentially break. What I'm going to do is I'm going to have my stop loss here. So if we break below this level, then I'm just going to go ahead and exit. Yes, I'm going to get a little bit crushed, but I'm not buying in at the height of the volatility. So I'm not going to get crushed as bad as if I bought, like say here, and then it pulls back down below here, then I'm going to get super crushed. So I buy in here and then it goes up and I'm like, okay, my price target is VWAP. So maybe I sell, somewhere in here. I'm buying the dip and I'm selling the rip. And that's where you're going to get the best bang for your buck with contracts. Otherwise, you're not, and they don't work the same as shares, obviously, because of all the Greeks. So yes, that is pretty much my lesson. I hope that you guys were able to understand that. We are 5 minutes before 5. I thought we were going to go longer, but I'm glad we're able to finish up now. So if we have any questions, I'll go ahead and open it up. If not, we'll end this here and we'll pick up with you guys on Monday and let you go enjoy your weekend.
I have a quick question. So you kind of just talked about it, but so you're in kind of anticipating breakouts,
correct,
more so than buying the breakout.
So yeah, when I trade options, I play the anticipation of the breakout with a stop loss. When you're trading stocks, you can wait for the breakout, right? So right here, this is where, like Ben Chafee, he loves to trade shares and he just started recently trading options. I don't actually know if he's in the call or not. Not that I'm throwing him under the bus or anything, but he comes and he trades breakouts, he trades momentum trades and everything. And it's different for shares, right? Because if I buy right here, for shares, then that's what the price is, but if I buy right here for options with all the Greeks that can, have an impact on it, if it goes ahead and turns around, then I'm going to get crushed, versus if it keeps going. So for me, I'm looking to enter like right here. And then I have my stop loss, down here. So, I see a big, strong move of strength. And it's like, okay, I think we're going to continue at some point. We just need to cool off a little bit. So I want to buy in the cool off before, we have some more strength again. Whereas with shares, you can buy in strength, sell in weakness. You can sell anywhere. And, the price of the share is still the price of the share. Does that make sense?
Yeah. So I'm assuming that's kind of one of the bases of like Nick's strategy is buy when it's going the opposite direction that you're playing it, and then play for it to reverse. So like, I'm assuming that low right there that you're talking about kind of coincides with the highs of earlier in the day, and you just kind of see like that volume come down and then start picking back up. So you kind of anticipate like, okay, it's going to keep going.
100%. Yeah. So like, for this move that I was talking about earlier, we have a fake out, right? So if you can like time this right, you can actually buy calls on the fake out. That's when everyone's like trying to sell their calls. That's when you're going to get the best price. And then you're going to get the best price for selling them either on this move or even this move right here. The strong moves is where you're going to get the best price for selling and the worst price for buying.
Yeah. So you kind of got to look at it more of like contrarian plays rather than breakouts.
Exactly. And so that's why trading options is a lot harder. That's why we wanted to focus on shares, because it is a lot easier to be profitable with shares. Obviously, the profits aren't as much, it would be extremely difficult, if not impossible, to do what I did with my $100 account with shares. Because obviously to find percentage moves like that on shares is crazy. Like you'd literally have to, luck out with trading AMC with huge moves every single day if you wanted to do that. And it's just not really realistic. Cool. Any other questions? I know we covered a lot in the last 2 lessons. Like I said, options are extremely advanced. There's a lot to learn. Anyone else?
And this may be something for a different lesson, but when you're looking to pick an option, are you looking more on your intrinsic, extrinsic?
So here, I'll do a quick breakdown on how I pick
okay.
options, right? So I guess this was something that I kind of forgot to go over. I kind of looked over it, so I'll go over it as well. So volume and open interest I think I went over this at some point. Volume and open interest are a big part of options, right? Because less people are trading certain strike prices than others, like SPY, people are buying and selling shares all day. So there's plenty of liquidity. Whereas with options, someone a 20, this goes kind of with psychological numbers as well. I'm going to switch back to SPY. Actually, no, I'll switch to a name like Shopify, so it's a little bit clearer. So I pick, when I'm trading SPY and QQQ, doesn't matter as much what I trade, I'll show you what I kind of go for. When you're trading other names, it definitely has a bigger impact. So I'm looking at Shopify, right? And this usually has very wide spreads. So you can see the volume and open interest. So volume, I believe, I'm forgetting here. Volume is how many people have bought and sold it, I believe, in one day. And then open interest, I believe, is how many people are currently in it. So you can see that the 700s, the volume and open interest is a lot higher than the 695s, right? Shopify isn't like a super well-known name like S&P 500. So you have to stick with the contracts that more people are trading if you want to actually get filled, because there's higher supply and demand for those contracts. So we're looking at the 700s, psychological number, open interest, volume and open interest is much higher. If we even move down one, we see the volume goes from 666 to 151. The open interest goes from 275 to 85. And we can see the spreads on these are $140, whereas the spreads on these are $210, right? So the supply and demand's higher for the 700s than they are for the 695s. So that's where, choosing a contract can be important. Now, this can be tough if, you're looking to play something out of the money and there's just nothing really good. So then maybe you just don't get to trade that, right? And that's a decision you have to make. Okay, am I good with the spreads on this, right? Because obviously when you're entering and exiting, and like I said, this is kind of why I love trading SPY, because I never have to worry about this. This is, I don't even look at volume and open interest when I'm trading SPY, but when I'm trading Shopify or even like Amazon, I have to come in and you can see like right away, I look at Amazon, I see 1,000, I see 1,300, I see 3,800. Those are all ones that I want to pick. And you look, we have the 3,300. Obviously, that's a psychological number. That's, big whole number. So, that's where there's going to be a lot, more volume and open interest. And then we have right here, 3,280, kind of the same thing. And then right here, we have 3,260, so every 20, you can see we have a higher volume and open interest. And the spreads are going to look different. On the 3,300s, you can see we have a much tighter spread. We have a $175 spread versus on the 3,295s, we have almost a $300 spread. So this is something that you have to keep into consideration for, smaller volume names. So like maybe if we even come over to like NEO, you might be able to see something like this. You can see usually when it's in the thousands, you don't really have an issue. And that's why I like SPY, because if we come over to SPY, you can see everything's just like crazy. Now, obviously, you're gonna have more spreads higher in the money because not as many people are playing those. So you can see you have a bigger spread here. But like at the money, you literally have a $1 spread, $1 spread, $1 spread, $1 spread, $1. Like these are all dollar spreads. So that's why like I love trading SPY and QQQ. Never have to worry about spreads. You know, as long as I'm, you know, just like I went over with you guys, buying in at the right time, selling at the right time, I'm gonna get good fills. You know, this is not something that I really worry about with trading SPY. As far as picking options for me personally, you know, it really depends on your risk and how much you're willing to put on. So I'll say if I'm playing less risky and say I'm playing $1,000 account, let's go ahead and move over to Neo. So with $1,000 account, right, say on Monday, you know, which is going to be closer to the price of these options. You know, okay, Monday, if I'm playing calls, you know, let's see, we got a lot of open interest for the $23 calls. I know time decay is going to be a lot less in effect on a Monday than it is going to be on a Friday. Okay, you know, I'll play the $23 calls. And maybe I'll play 4 of these. You know, I'm willing to risk 20%. Maybe I'll even play more. Maybe I'll play like 5, 6, 7, 8. Maybe I'll play 8 of them and I'll risk 40% with a tighter stop loss. You know, that's something that I'm cool with doing. You know, this, you know, 23, nice round number. It's only 3 strikes out of the money. So we're going to have good movement. You know, rarely do I trade in the money unless it's on a Friday 0 DTE and I want to play less risky. That's really the only time I'm trading in the money. And that's kind of the same with most traders. You know, we have our text alerts that some of you might be aware of. On Fridays, Shafi handles the shares plays and I handle the contracts. Normally on Fridays, I'm signaling for those plays specifically, contracts that are in the money or right at the money because they're less risky for big moves. And then for SPY and QQQ, I'm just usually playing the strikes that are, so if we actually come back over to SPY. So like today I was playing April 4th expiration. So these expire Monday and I was playing anywhere between like 1 to 4 strikes out of the money, just depending on the play that I want to take. Okay, you know, maybe I want to take 3 contracts here so that I can trim a little bit more because I have more price targets, or maybe I'm just looking for that big move and I just want to play, you know, this strike and play less contracts. But usually when I'm trading, I'll play 1 to 2, sometimes 3 days till expiration, you know, because with indexes, like I said, you have contracts that expire Monday, Wednesday, and Friday. Sometimes, like if the market's closed on a Monday, it'll expire on a Tuesday. But with indexes, you have options that expire Monday, Wednesday, Friday. So SPY, QQQ, the Russell, some other indexes that I probably like VOO, I'm sure. It's another index. VOO, never mind. I've never traded VOO in my life. Probably never will. SPY, SPX, obviously, that's just the futures of SPY. One of them. So, you know, they expire Friday, Monday, Wednesday, Friday, Monday, Wednesday, Friday, yada, yada, yada. So I trade. So like today, I was trading Monday. On Monday, I'll trade Wednesday. On Tuesday, I'll trade Wednesday. On Wednesday, I'll trade Friday. On Thursday, I'll trade Friday. So I'm just usually sticking between 1 to 2 days till expiration. That way, Theta is not ripping at me, but I'm still getting the benefits of Delta and Gamma and Vega at a higher level if I'm catching a good move, and then I'm not getting absolutely crushed from Theta when the move goes against me. So that's why I trade 1 to 2 DTE, and that's my favorite. You know, for other names that are trading with contracts that expire once a week, you know, Wednesday and Thursday is my favorite day to play those names just because of the movement that you get from contracts. And if you want like even safer plays, the price is more expensive, doesn't move as much, but you can play even further out, 1 week, 2 weeks, 3 weeks, 4 weeks, and you're not going to get as dramatic of a move because the contract's, you know, not expiring as soon, but it'll be safer. I know that was like probably super in depth, but I feel like that was a necessary thing to add as well. So I don't know if that answers your question.
Yeah, that's fine. Do you trade pretty much strictly on TOS, or do you do Tastyworks as well? Or
I I mean, sometimes I screw around Robinhood, but
Basically, like when I'm looking for something, you're just strictly looking for indicators that that's a good trade. And I know like on Tastyworks there's a probability of profit percentage
Mhm.
that goes with it. I guess takes the legwork out for you.
the
Yeah.
TOS has that as well. They have let's see, where is it? Probability out of the money. Right here. So I mean, there's
So
that.
that's your pop.
Yes. So I guess there's that, but yeah, I only trade on Thinkorswim besides like screwing around on Robinhood.
Do you only look at the spreads for, or like, do you have a threshold for open interest and volume, or is it just like if the spread's tight enough, it's good?
Yeah, I just look at the spread, right? I'm not really going to trade something that has a spread bigger than like 5 or 10%, especially if I don't think I can get a move like double that at least, right? You know, so if I'm coming over to Shopify and I think that, you know, I'm playing say the 700, there's almost a $200 spread on the call or $150 spread. If I don't think that I'm at least going to make like $400 out of that, then there's no reason for me to take that, right? Because automatically if I buy and sell, I'm losing $140 right there. So, you know, which, you know, the spread is going to widen when there's any volatility, right? So when it's standing still, when the stock isn't moving much, that's when the spread's going to be the tightest. If it's moving dramatically up or down, that's when the spread's going to be the widest. So you have to be really careful, because if the stock moves against you, then it's super easy to get crushed by, you know, obviously all the Greeks plus the spreads, right? Because demand is low. So who wants to buy, you know, during that? So you'll see these spreads really widen up a lot when big moves are happening, which is great when you're trying to sell, but sucks when you're trying to get out if a move's going against you. Whereas with SPY, you know, they don't really widen up as much.
Okay. Do you scale in at all, or because you're anticipating and because the Greeks are going to start working against you as a move happens, or you just kind of buy all at once and then scale out?
Today I scaled in a little bit, but usually I tend to buy all at once, you know, or I played multiple plays, right? So if I'm, you know, I see a play, depending on how confident I am in that play is how many contracts I'll put on that, or how much of my account I'll put on that, rather percentage of that. So if I'm really confident in a play, you know, I'm trading my $100 account, but I'm trading that like risk on. So maybe I'll put like 50 to 80% of my portfolio on that, which I really don't recommend for anyone that doesn't have a great understanding of options, because it's easy to lose all of that or half that. Whereas, you know, like I have a tight stop loss and I know how I want to get executed if the trade goes poorly. You know, I have a great plan for entry, exit for a loss, and exit for a profit, where I'm not going to get absolutely annihilated. So I will play bigger. And obviously as my account gets bigger, I'll probably play smaller because I would be risking more. But sorry, what was your question again? I totally.
Just about if you scale in or not.
Yeah. So I usually buy all at once and then I'll scale out. And then if I see another trade, I'll buy in all at once and I'll scale out. So instead of like scaling in and out, I tend to just take multiple trades, and I'll just buy in, scale out, find another, you know, opportunity if there is one, buy in, scale out.
Okay, cool.
And just like to throw in there like a little strategy that I like to use. I buy in and then I start to scale out. Once I start scaling out, that's when I move my stop loss to break even, so that I, you know, am 100% locking in profits and I'm not losing any money on the trade. Unfortunately, that happened to me like 4 times today, and my account that's now sitting at like $772 would have been sitting at, you know, closer to 1,100, 1,200, 1,300 today. That would happen, except today I got kind of greedy and I didn't scale out of my positions because I wanted the full effect of if that actually kept going. And then it turned around and it came back and it hit my stop loss. Fortunately, I did set my stop loss at break even. I know someone asked this in chat today as well. They're like, why don't you stick to your normal stop loss after you've entered the trade? Simply because, you know, if I'm in a trade that goes green, I don't want to have it go red, right? Because I'm going to be like, wow, like, you know, that's just going to automatically want, bring in the emotion of you wanting to revenge trade, because it's like, oh, well, I was green, you saw the profits, but you didn't take the profits, and now you're red and you lost the money. Now you want to make that money back. So when I enter trades, I enter them once they go green a certain amount, couple percent. If it's like 3, 4, 5%, then I'm setting my stop loss to break even. That way the trade can't go red. And if it gets stopped out, then I just wait for another opportunity and I take that. There's plenty of other opportunities. I'd rather not risk money like that and have it go negative than I would, have it go negative and hopefully go back to being positive. So that's a big thing there that I think a lot of people need to implement. And, that's just like, once your trade goes green, set your stop loss, like trim some and set your stop loss, or just set your stop loss at break even. If it doesn't work out, if it doesn't hit your price target, move on to the next one. I got a little frustrated because it happened to me 4 times in a row. One time is one thing, but I just, like, it happened to me a whole bunch. So I just got frustrated today and I ended up just stopping because I was getting frustrated.
Yeah. Do you use hard stops in TOS? Because I've noticed, like, even with the liquid contracts, like, you lose a little in slippage if you set your hard stops. So do you do like a few cents or whatever above where you actually want to stop out?
Yeah. So when I'm trading contracts, say I come over into charts and let's load a contract that actually has value right now. So say I entered in at 130 and it goes up to 140, 145. I'm like, okay, I don't want to lose money on this. Then I'm going to set my stop to like 132, 133. That way it covers when I get filled for my stop on the trade. It's a market fill for the stop, right? So I got to assume that the fill is not going to be as good as a limit fill. And, it cost $1 or I believe 51 cents to buy the contract and another 51 cents to sell. So that means every time I'm trading a contract, no matter if I win or lose, it costs me $1.02. So, that's like, okay, if I bought in at 133, automatically, if I had a limit stop, it'd be 134, so that I'm only losing 2 cents. Realistically, I'd love to have it 35, so I'm still making money either way. And then, this is where like a trailing stop can be cool too. But then I also have to plan for market fills, which are not as good, right? Market fill is like, limit fills will be like, I want to get filled at this price and I don't want to get filled until I get this price. Market fill is like, oh, whatever price, I'm good with that, I'll take it. And for liquid contracts, market fills aren't bad at all. If you play like Shopify, you never want to use market orders because you're literally just getting burned. But for SPY, usually you're fine. Sometimes if a big move's happening, you can get kind of crushed and like you might have a $5 miss. So sometimes you can get burned, but usually on SPY, I'll set my stop like 3 or 4 cents above my entry price. So that way I'm not losing money when it goes back down and break even.
Yeah. I'm surprised there's not a way to set it so like if the bid hits your stop, then cut it instead of like making it market.
I think you could do that. I don't know like how complex that is. I know that when I just click here and say, stop, then it sets it automatically. So it's just a lot quicker.
Yeah.
All about simplicity and, being light and quick and everything. So that's what's important for me, at least. But yeah. Any other questions? Cool. Well, look forward to catching you guys on Monday, and I will make an effort to trade live with you guys before 10:30 with Shafee and Nick. I'll make an effort around like 9:20, 9:25 on Tuesday to trade with you guys, and I'll go over order flows a little bit, which you can see right here. So we'll go over order flows a little bit and how I use them to help make decisions in my trading. But yeah, that's pretty much it. So I'm going to go ahead and stop it here, and I'll catch you guys on the next one.
All right, thanks. See ya.
You got it.
See you guys.